We've been long investors, but we are one of the largest FIs actually investing into India. We invest on behalf of sovereign wealth funds, rich people across Switzerland, UK, mainland Europe. Some of the global private banks, when their HNI clients tell them they want to invest into India, it's quite likely that one of the funds recommended is a WhiteOak fund. I am CEO for Motilal Oswal Asset Management for nearly 8 years. Last 5 years I've been with WhiteOak Capital as the CEO. So totally WhiteOak manages over 10 billion.
I came across this WhiteOak market perspective report. Hey guys, so in today's episode, we have got Mr. Aashish Somaiyaa from WhiteOak Capital. Now, obviously, WhiteOak Capital is one of the biggest funds in India, and they're also an international fund. So they manage global equities and they manage India equities. Their domestic business is more than 33,000 crores that they actually manage in India as well. And Mr. Aashish Somaiyaa is the CEO of the domestic business. Now, if you also remember, some time ago on the YouTube channel, I had made a video called "This is the best report I read," and that was the WhiteOak report that was there. So in today's episode, we have the CEO itself, and we will be going through another report, the latest report that has come out, and we will understand a lot about the Indian markets, Indian equities, portfolio management, and a lot more. So stay tuned and do not miss this. Also guys, all of this is possible because we are part of the Grow Network, and they have been instrumental in supporting our channel so that we can grow as much as possible and put out some really good content for all of you guys. So if you want to understand more about Grow, you can definitely check out their link in the description below.
So thank you, Shashank. Thanks for inviting me. So I work for WhiteOak Capital Asset Management. It's part of WhiteOak Capital Group. So when I say group, it's been in existence since June 2017. Set up by my colleague, our founder. His name is Prashant Khemka. So Prashant founded WhiteOak in 2017, and prior to founding WhiteOak, he was Chief Investment Officer for Goldman Sachs Asset Management. He was focused on global emerging markets. So when he started WhiteOak Capital, we were, in the early days. Since the early days, actually, we've been a preferred manager for global investors to invest into India, right? You and obviously your listeners, sometimes randomly or even unsolicited, every evening you must be getting a message how much FIs have bought and sold.
Yes.
So, we've been long investors, but we are one of the largest FIs actually investing into India.
Wow.
And we invest on behalf of sovereign wealth funds, pension funds, university endowments, rich people across Switzerland, UK, mainland Europe. So in certain cases, we are managing it more as a separately managed account as a mandate. And in certain cases, it's actually a mutual fund, like a European mutual fund, which is called a UCITS. So, some of the global private banks, when their HNI clients tell them they want to invest into India, it's quite likely that one of the funds recommended is a WhiteOak fund for foreigners to invest into India. Say nearly about 6 billion is our global business, which is global money invested into India. And I am CEO for the domestic business, where we manage approximately 34,000 crores, just around 4 billion. And that is mutual funds, portfolio management services, alternate investment funds, pre-IPO funds. That's our domestic business. And we are also a manager for global emerging markets strategies. So totally WhiteOak manages over 10 billion. We are about 350 employees all over the world, maybe largely in India, but apart from India, Gift City, Singapore, Dubai, Switzerland, France, Germany, UK.
And what about your journey? How did you reach WhiteOak? Like, where have you been before, and what is your journey to this?
Yeah, so I started actually working in India's mutual fund industry since, I was a trainee in 1999. So I joined as a management trainee and then get a placement offer. So I worked with ICICI Prudential Mutual Fund. I had 2 stints there, totally worked 12 years.
Okay.
So in end of 2012, I was head of sales and sales products and multiple functions at ICICI. Then I moved out of ICICI. I became CEO for Motilal Oswal Asset Management. I was CEO there for nearly 8 years.
Wow.
So end of 2012 till end of 2020. And now since give or take couple of months, last 5 years, I've been with WhiteOak Capital as the CEO. So I've been pretty much been in the mutual fund industry since late 90s.
So you've seen all cycles. You've seen a lot of cycles in the market then.
Yeah, many cycles in the market. And, dramatic change in the industry actually in the last 25 years.
Wow. So I want to tell you guys a very funny story, and this is where the fanboy moment comes in, right? So 4 months ago, because I'm a retail investor, so not a big fund and all of that, right? So I came across this WhiteOak market perspective report, and it was a big report, but it was amazing because it gave me huge insight into the markets from a long period of time, how things were changing. It was not stocks, but it was dissecting the market, right? And I did a video on YouTube live and said this is one of the best reports I've read. Cut to today, after 4 months, I'm sitting with one of the guys who have actually been instrumental in making the report. And for all you guys thinking this is not some paid PR podcast or whatever, this is just good destiny and luck by chance and mehnat. And because I'm RA, I'm supposed to give all the disclaimers. I have asked Mr. Aashish today, because they've just launched the August edition as well. I only have the June. So I want to go through this report, some important slides because it's 60 pages. And mainly I want the audience to understand different perspectives of the market.
Absolutely.
Right.
So I'll just tell you very quick background, Shashank. Why did we make that kind of report? See, generally you expect reports to be very forward-looking and to predict things. You may have noticed this report doesn't make any prediction. But my own learning is that before you start even thinking of the future, before you start thinking that you will be capable of taking a call or making some call or some forecast, I think what I find most people don't understand the lay of the land itself.
Understood.
Right. So let's say you want to construct a portfolio to beat BSE 500, the index. First, you need to understand what is the index made up of. Yeah, because the index is like, it's not this, we call it benchmark. It's not like a static table like the one which our hands are rested on. The benchmark itself is a live portfolio. Benchmark has a mind of its own. So, for example, if you don't understand the market from a lay of the land perspective, you can't hope to make a portfolio which will, perform well. So that's the whole idea.
So this report is basically breaking down the index and finding out how they move and how they flow and how they operate.
Markets, fund flows, index itself, the journey of the market, how it has behaved. Yeah. All of those.
Wonderful. So can we quickly go into screen share mode and look at it?
My pleasure.
Wonderful.
My pleasure.
Okay, so let's go into it one by one. This is the August edition that you have. So I can't believe I'm doing it with you today, but it's crazy. So this basically talks about the Sensex EPS growth, right? And it has also shown that the Sensex EPS growth CAGR, EPS is earnings per share, is approximately 16.7. And the benchmark Sensex TRI is also around 18. So any insight on this?
See, a lot of times what happens is that what I realized, there is a starting point bias. People look at index in isolation. So, if you ask anybody, they'll tell you, last 5 years, since the bottom of COVID, market has been crazy. It's just been, on a tear, that kind of thing. But what this data actually tells you, what people don't realize is that in reality, the Sensex has delivered as much as the growth in earnings.
Yeah.
It's not done something crazy.
Yeah.
Right? While the market has gone up a lot, all said and done, when you look at this data, you will realize it's gone up in line with the earnings. It's not done something. You can always question whether it will sustain in future or not. So I will say yes, that will depend on whether earnings will sustain or not. But so far so good. And see, the other thing what you should keep in mind, it tells you that even at a trailing PE level, the PE is actually going down.
Trailing PE level. Yeah. Yes.
So see, when you see the first column, after the dates, when you see the first column, it shows how the Sensex has moved in last 5 years.
Correct.
Then it tells you that while the Sensex has moved, even the EPS of Sensex companies has actually moved as much.
And this is historical, right? So
yes, of course.
Understood.
And then it says that the PE multiple has actually gone down, which means that there are periods when the earnings has gone up much more than the index itself, right? And at the end, you can see even the quality of earnings, the return on equity, the efficiency of companies has also actually been on an improvement trend.
Yeah.
So there's no reason to think the market has done something crazy.
It has done what it does.
It's done what it does. It's done in line with the fundamentals.
Yeah.
And before this, if you look at 2015 to 2020, it won't look so good because at that time, the earnings was poor. Yeah. India's GDP growth at the worst point, we had negative GDP growth after this COVID.
Yeah.
And even before COVID, 2019-20, our GDP growth was less than 4%. Right? So market is moving in line with fundamentals. That's what it tries to tell you.
Got it. And then you have this slide which also backs that theory of that market is always going up, right?
See, long range, basically what this tells you is 2 or 3 things. One is that it tells you, first of all, I would like to clarify, it starts with financial year 23, so 93.
93,
90 to 93.
93.
Lot of history of the market, Shashank, always starts with 1979 and all. I personally think you should never start with that. The reason is because why it starts with 90 to 93 is because our real economic history started from here. Before this, for most sectors, there was no private sector.
This is after the liberalization.
Yes.
Okay.
Before this, private sector was not allowed to invest. And obviously there was no, if private is not allowed, obviously foreigners are not allowed, right? So now moving forward, it tells you that in the last 32 financial years, India's nominal GDP growth is 12.4% compounded.
Correct.
So, you say 6.5% growth, 6% inflation, give or take. The nominal growth is 12.5. Now, we are blessed to be in a country where the economic structure is such that the economic growth reflects in corporate performance.
Yes.
Right? So, if you see the GDP growth and the EPS growth of the top companies is in line with the GDP growth itself. And the Sensex itself has compounded at close to 12% plus dividend yield. So maybe must have been about close to 14% compounded for the Sensex itself over the last 32 years.
32 years.
So in the last 32 financial years, on average, the index has doubled nearly every 5 years.
Wow.
Why I say on average repeatedly is because in good times it doubles in 3-4 years. In bad times it might take 7-8 years.
But that's always the case. Good and bad
generally, good and bad times, generally, on average, in 5.25 years, the market has actually doubled.
Got it. And you've actually made that good and bad years as well in this. I know this took a lot of effort, but this was like, when I saw this for the first time, I'm like, holy shit, right? The first thing that came into my mind is like, what are we looking at all this Trump tariff? Because we've been through 100 other problems in life.
That's so you got the right perspective that, look, in the long range, it doubles almost every 5.25 years.
Yeah.
But, it goes through all of this. And that's why they say, markets always, kind of climb a wall of worries. That's why it says, that while volatility has been a feature of the markets, so has been growth. I mean, growth has always come with volatility.
So relax and just keep going ahead.
Yeah, and every time there's a new circus, but what we are witnessing even now is not something unheard of.
Yeah, exactly. And this was a very interesting data point. So you want to explain a little bit of this, what this is? Because it's very interesting even for me when I saw it.
So you have to see these 3 slides in conjunction actually. That was my intention.
Which one?
The one with the long range data with nominal
Correct.
GDP growth. Then the one which I said that, it's a usual circus. I mean, basically what I intended to say is that every year for a different reason, markets are ultimately reflecting what is happening in economies, what is happening in the world, and nothing moves linearly. So what this chart actually tells you is that, see, it has a blue bar and a green bar. And below all the calendar years are written.
This is year on year.
It's every calendar year.
Every calendar.
Yeah. The takeaway is 2 things. One, every calendar year, almost every calendar year, at least once, from the high point, the market falls double digits.
Okay,
from the highest point in the year to the lowest point in the year. Take any year. From the highest point to the lowest point.
It always falls 2 times.
Double digit, maybe 15%, 20%. You can see, right? See, say 2008. Forget 2008 and 2020. They were outlier, minus 59, minus 38. But even normal year, minus 12, minus 15, minus 14, minus 14, minus... See how many times you're saying negative double digits or how many times you're saying negative teens.
So on an average, it would be minus 12. We're almost hitting every year.
Yeah, on an average, 12 to 15% down is normal. It's par for course. And then the green bar, it tells you that eventually if you take 1st Jan to 31st December, where did the market land up? So there are 2 things in this, that in this 20-25 year data, it basically tells you that every year once, for some or the other reason, the reasons are in the previous chart. You saw all those marked. So for some or the other, you say, right, in movie terms, you say that, it's a different story, different actors, but the script and the plot is kind of same. Right? The other important thing in this is that we tell people that, if you invest long range, 14-15% compounded, you get SIP, you should do, etc. That's what the thing is. That's a practical experience. But if the long range compounding is 14-15%, and every year the market falls 14-15%, then for a smart guy, it's a very big opportunity.
So you're saying every time every year the market's falling because the data is given. Yeah. So anytime it starts going index level, anytime the index level starts going around 10 12%, it's a very good time for you to start
absolutely.
banking down.
See, if it's at 26,000 and it starts falling, I don't know whether it'll stop at 22 or 21.
Yeah.
But I'm seeing it going down below 23 and 22, right? So anytime the market is, say, 12-15% down from its previous peak, is time to
It's playing its natural
develop
role.
your SIP or add a couple of more installments to your SIP. And this is, Shashank, this is Nifty. You should just for a moment see small cap.
This is Nifty 50. This is mid cap.
Mid cap 150.
Okay.
So
and
now
we'll
you know
go-
that 12 to 15% average will become more like 20% average.
Correct.
18-20% average.
Correct.
And if you go to small cap, it will become more like 20-25%. You know, the declines are bigger. See, every 2-3 years, once it falls 30%.
Ouch. Just now it also fell. Recently it fell quite a bit as well.
Yeah, we are in 2025. At the worst point, small cap must have been 24-25% down.
Yes.
It shows minus 23 at the worst point.
So this is also good learning, because for people who are investing in the small cap companies, so be ready for 2025 every single year. I mean, almost every single year.
This
on
is
data
index.
average.
This is index. I mean, the
You will
stocks
be
would
much
have been
more.
minus 50, minus 60 also, some of them, right? I mean, take for instance, when the index fell, take for instance, capital market stocks earlier this year, even some broking companies fell 45%,
Correct.
right? So
And they're
capital
free cash
market
flow
stocks
players and
fell,
all of that.
Yeah. So the beauty is that, yes, continue your SIPs, continue whatever. But, Mr. Buffett said, be greedy when others are fearful. Be fearful when others are greedy. I always ask people, that what's the most important word in this phrase? People say greedy, greed, fear. I always tell the most important word is others. Because it's about observing what others are doing and ensuring you are not part of the
Others.
So if you keep all this in mind, see, every time people are panicking, if you can take a step back and say, ये तो हर साल का circus है.
और ऊपर ही
It's
जाता
happening
है.
every year.
Correct.
Then you will be a bit more sanguine and a bit more balanced in your thought process, because controlling emotion is everything. If you keep all this data in mind, you will not get emotionally carried away. And only then you will be able to go against the crowd.
So a smart guy, even if he just does, let's say, index rotation, and he does a good SIP during only the falls which happen every single year on an average, he will be outperforming every time.
If you don't do SIP, let's say for some reason you feel, okay, SIP is just like, shooting for the averages. Let's say you don't do SIP.
Correct.
Then your other rule can be that, okay, I keep money in my bank, but every time the small cap index is more than 15% down from the top, I'll start slowly deploying.
वो तो होता ही है.
Between minus 20 and minus 30, I'll get deployed.
Superb.
So from the previous peak, you keep observing. Whenever the market makes a peak and starts going down, that's when you get into your attention mode.
Yeah, by default, you'll by just maths, you'll beat the index.
Yeah, of course.
Yeah, so this is a very interesting slide, because this has shown the expansion of contribution to the total market cap of India. And right now, everyone is talking about mid and small, but that was not the case before.
Yeah.
So can we go a little bit into this?
So Shashank, this is, at the onset, I told you that, if you're making a portfolio, you should have a sense of what's the lay of the land and how is your portfolio looking vis-a-vis the broader market averages. Because I have, at some point in time, I'll also share some data with you, but quickly, let me just mention it out here. If you take the mutual, like I've been with the mutual fund industry, so that's what I track. If you take mutual fund industry's data, say we are on, 30th June, AMFI has released the data already. So as of 30th June, if you see, you will find that the previous 12 months, literally 60 to 70% of the net inflow into equity mutual funds went into some or the other sector fund, thematic fund, small cap fund or mid cap fund.
Okay.
And those sectors and themes also, Shashank, were not big ones like bank, IT, consumer or healthcare.
Is it
the sectors were
ones?
The energy, defense, infrastructure, those kinds of
So is that
railways.
a good thing or a bad thing?
Yeah, so I was just telling you that this slide, why you should understand lay of the land. People are putting 70% of their money into small cap, mid cap or some narrow theme like defense, energy, railway, infra, PSU.
Oh, I got
right?
it. Huh.
Let me put it in a more pedestrian, ordinary way of talking. If I visit you down south, you will, come, you will order a thali or something, right? I mean, I would love to eat it, right? Now, when you visualize that thali, what do you see is the biggest portion in the middle of the plate? Rice. But somewhere on the corner, there'll be a little bit of some chutney and some pickle. Now, you visualize a thali where instead of rice, there is green chilies, pickle. And where there should be pickle, in that much quantity, there is rice.
मजा नहीं आता है.
No, now you visualize consuming that thali. The thali where as much as rice you should have, there is actually pickle full of green chilies, and as much as pickle you should have, there is actually rice. Now I consume that, and then I ask you, Shashank, if Mr. Trump continues his rhetoric with tariffs, what do you think will happen to my portfolio? So you'll say, bro, you anyway eat only pickle. Why are you worried what will happen tomorrow morning? If you eat only pickle, tomorrow morning you are anyway going to be in trouble. Same way, if your portfolio is full of narrow segments of the market, if your portfolio is full of volatile small caps, if all that you consume is only pickle, then what's the point bothering? Then what's the point losing sleep over what will happen tomorrow morning? It's destined to be that way. If you make a cricket team assuming I'll win the toss, right? Let's say we all watch T20. Every T20 team is 5 to 6 batsmen, 2 to 3 all-rounders, 3 to 4 bowlers, and the wicketkeeper is always a good batsman. Now, because you're meeting me in Mumbai, I tell you, Shashank, tomorrow there is a match in Wankhede, and you know Wankhede, randomly people score 200. It's a batting pitch. So I'll tell you, Shashank, I think we should win the toss, elect to bat, and we should hit 400. Let's go with 9 batsmen. Let's make an aggressive strategy. And then, we ask our friend here, what do you think of the match tomorrow? How do you think it'll play out? He said, boss, what match? There'll be only toss. There'll be no match. Right? Because the way you're thinking, when you land up at the ground, first thing will happen, you will lose the toss. And the other guy will elect to bat. He will hit you 500. There's no match. There's only toss.
Yeah.
So what happens? People make their portfolios, which is not even a portfolio. It is something standing in the corner of a playground. See the market. The market is still 60% large cap. And in fact, if you take long period averages, the total composition of the market is 65 to 70% large cap.
But people are playing in the mid and small.
Yeah, they're playing only in the mid and small.
And pockets of mid and small.
And only in the pockets of mid and small. Even in mid and small, last year, if you bought healthcare and IT, I said first only that when people have put money, even the thematics are not bank, IT, healthcare and consumer. The thematics are all chili and pickle as per the framework which I told you. It's as good as saying that I will enter the playfield with only 9 batsmen, right? So you never make a cricket team assuming you will win the toss, correct? You never consume a whole lot of pickle assuming that, I'll drink some amazing, magical water and it will all get sorted. You don't do all of those things, right? You make a cricket team assuming you can win or lose the toss, assuming you will bat or you will bowl. So your portfolio also should be done that way. Your portfolio also should have some tethering or some anchoring to the broader market. If the market, and this is just the market cap, if you look at it in terms of sectors, the market is still 70% bank, IT, consumer, healthcare, and maybe industrials and capex. The market is not 70% small cap, and the market is not 70% your favorite sectors.
But don't you think that's now becoming a problem? If you're saying that much fund flow is coming into the DIIs, SIP inflows coming into DIIs with pockets. Now those pockets have to be bloated or the DIIs have to hold cash.
So you'll find it very interesting that if you actually see the SIP flows, yes, there is a little bit more SIP flow in small cap, right? I mean, I would say that in the industry, say nearly 35% of SIP flow must be in small cap. But Shashank, that is coming as SIP. Assuming your SIP will run, you will tide over the volatility. The problem comes for the people who are making discretionary or lump sum investment. Because when you do a discretionary investment or a lump sum investment and you get your entry timing 2024, say wrong timing, you bought all railway, infrastructure, energy, defense in 2024. It's not even an SIP, let's say it is lump sum. Now 1 year later, all those funds return is zero, no? Or some is even negative.
So what are people doing wrong? How can they not, you're saying build a balanced team?
Of course, that's why I said that your portfolio, how you make your cricket team, how you make your thali, the same way your portfolio should have some tethering or some reflection of the playground in which you are playing. Your portfolio, if it is completely skewed to what you think is your favorite, and by the way, how did you form that favorite? By, noise or last 1 year return, descending sort of last 1 year performance, correct? So then it will always happen that way, right? I mean, in 2000 and, in 2021 and you will end up buying a tech fund, right? In 2015, you might have ended up buying a pharma fund. So you'll always get your timing wrong if you have recency bias. And on top of it, even if you have recency bias and if you put some portion of your portfolio which is not completely disjointed from the averages in the market, it's still okay. But in the market, if that sector is say 2% and in your portfolio it is 20%, in future when that sector starts underperforming, in the market it is 2% of the market underperforming, in your portfolio 20% of your portfolio is actually down the drain. Right?
Got it. So this has basically also shown that large caps, which had 77% weightage in the past, have now come down to 59.
Yeah.
And the mid and small caps market cap as a total have also gone up quite aggressively. Is this because the quality of mid cap and small cap companies are increasing, or is it the fund flows been pushing the valuation to beyond necessary means?
So there are 2-3 reasons for this to look like this. One is, where are you in the market cycle itself? So we are clearly not in the doldrums as far as market cycle is concerned. In fact, we are 1,000 points shy of the, yes, we have been time correcting and valuations are kind of slowly coming off because we are time correcting, but we are close to the kind of, high levels.
Yeah.
So small and mid cap weightage rising is also an indicator of bullish times.
Yeah.
Right. That is one. Second, in the last few years, there have been huge number of IPOs.
Yes.
Right. And what will happen is that all of that, a lot of every listed company is not obviously not LIC or something, right? I mean, everything is not HDB or whatever, right? So a lot of it comes in the listed space itself is rising.
The mid and small.
Yeah, so that will also come in mid and small.
Correct.
What will happen is, even if an LIC gets listed, it will enter straight away in the top 100 stocks. So it will push something down into 101 or 102. So that also will result in more small and mid cap. So it's part of market cycle, it's part of listings, all of those. But ultimately, a lot of these things are, and earnings. I mean, even small and mid cap earnings have been better. We have to watch for sustainability, but small and mid cap earnings have been better. But, the average can shift a little bit, but ultimately it is mean reverting. You can say that in the past, large cap was on an average 70% of the market. After all the factors I told you, it can be 67 or 68% of the market. Even in a mean reverting phenomenon, we know that sometimes the mean can shift, but I don't think the mean shifts by some 20 percentage points or 15 percentage points. Right? So, and now we know that small and mid cap valuation wise also is trading at a big premium to large cap, compared to even, historically it may have traded at premium, but now in terms of premium it is at a very
high premium,
elevated premium. Yeah.
Got it. So when the mean reversion happens, the mid and small will come back to their original historical or new mean P.
Yeah, I mean, this 40 could become 35 or something. So, you might find that relatively for some time large caps do better. Or sometime what will happen is that it doesn't mean small and mid cap will fall. If large cap does relatively better, automatically it gets.
And this we saw that, right? Because last few years large caps didn't do that well.
Absolutely.
Mid and small did phenomenally well.
Yeah. But my message here is not to tell your listeners that buy large cap. That's not my message. My message
know
is
your
that,
playing field.
Yeah, know your play field. Keep in mind, I mean, what your portfolio is doing versus what the rest of the market is doing. I mean, don't go completely different playground. Yeah. Because then, you might just be left out of the game.
Absolutely. So this is a slide on valuation perspective, right? And this is different market cycles and how Nifty PE, forward PE, which is what people look at, which is the future, right? Which usually gets discounted and sometimes get overhyped during the good runs as well. So how this has played out over time. And right now, I think we're above the mean or median, right?
Yeah.
10-year average, we're above the median.
Above average, yeah.
So, and you have also put how the growth rate of GDP of India versus the average growth rate of our growth is. So, do you think this is now we are actually overvalued from a Nifty P standpoint, or is this the new standard?
So, Shashank, right at the onset of the conversation, the first slide that, you and me were discussing, and I told you that most people think that market has gone crazy, it's gone up a lot. Basically, the idea, and, there we explained that, yes, it has gone up a lot, but it has gone up in line with its fundamentals, right? Now, this also actually, so if somebody tells you that, market has gone crazy, it's gone up a lot, and, sometimes, people even make conjecture like, it's all just a bubble and it's just going up because there is so much money coming in, etc. See, in parts, almost everything will be cause and effect, and almost everything will have some explanatory effect on whatever is happening.
Yes.
So nothing can be neglected. But broadly speaking, my belief is still that the market has done what the fundamentals are reflecting. So let's take an example. In the, and talking of valuations, now you can see there is a period there, say 2007, 8, 9, 10, etc., right? Or 2005, 6, 7. Now, if you see 2005, 6 and 7, there is a big, bump up in valuations. And you remember 2006, 7, 8, the market really rallied. At that time, when the market really rallied, India's GDP growth was 8% throughout. Capital formation, GFCF is gross fixed capital formation. Capital formation was rising 22%. So a lot of capex and a lot of private sector capex as well as government capex was happening, and the earnings growth of Nifty companies was 25% compounded.
That's crazy.
Yeah. Now see, 21-22 is when the rally started. Before that, you look at all the years 9 to 13, 14 to 17, 18 to 20. All of those phases, you can see that the GDP growth was declining or unstable. If you see 2014 to 17, 6% became 8%. 2018 to 20, it was 7. It fell all the way to 4. And by 2021, GDP growth became negative because of COVID.
Was it because of the high base of 2005-8 where people did capex, everything was...
So in this period, Shashank, actually from 2010 to 2020, more or less, you saw all this, what we used to say, India against corruption, policy paralysis.
Yeah.
Then in 2013, India was like fragile 5. There was a, US was talking about raising rates, taper tantrum. And in these 10 years, when the NDA came into power, insolvency and bankruptcy code, a lot of companies went into NCLT. There was a whole cleanup of the banking sector. So for a long time, banks were not in position to lend, right? And then you had demonetization, RERA, GST, ILFS default, credit crisis. Then you had COVID. So 2010 to 2020, the market did very badly. I think for the entire period, India's Sensex EPS growth must have been 3 to 4% compounded, right? But why in recent times, why I have been repeating that market has gone in line with fundamentals? In recent times, there's a huge traction in the market and valuation has gone up. That is because you see what has happened after 21-22. Once the COVID impact was behind us, GDP growth, 10% and 9%, right? And look, people say, yeah, but that's from a low base. So of course it's a low base. Even the market fell 40%. When the GDP growth became negative, market also fell 40%, no?
Correct.
So low base is not an explanation. In economic terms, it was low base, but in market terms also it's low base. So market has been following the fundamentals. And when we realized that during COVID, things are bouncing back, so market started to bounce back. And lo and behold, you actually saw 9% and 10% GDP growth. And you can also see free cash flow. You can also see fixed capital formation rising. You can also see Nifty earnings growth hitting 19%. Even now it is, 11% is in line with nominal GDP growth.
Correct.
So all of this is basically trying to only tell you that market has gone up, but you have to see it in phases. When it was doing badly, when fundamentals were bad, market did badly. When fundamentals have improved, market has improved.
Tomorrow, if we had to, let's say, mean revert into bad fundamentals tomorrow, we can see periods of us going below 18p forward, which was the highest average at that
time. Valuations are always forward looking.
Correct.
The market has a basic tendency to extrapolate. Market is all about extrapolating. Your discounted cash flow is an extrapolation. It's a hypothesis of the future. So markets by nature, markets are reflection of human beings, and human beings always extrapolate, right? So if you see, when the things are going good, the market will expect it to last. When things are going badly, the market will think, oh my God, it's going to be bad.
But do you think with the rise of retail income entering the markets, which everyone says is a good thing, now I can also say it can be looked at as a bad thing because most of them don't look at valuations. They are just pumping into the
money.
Like if it was all smart guys sitting on the table, they would all do the same math you're doing, right? Like an FII or a DII would not invest at ATP, but a retail investor would even take a better ATP.
What we have to keep in mind is that ultimately, in the long run, 2-3 things to keep in mind. First is that in 32 years of our history, with all types of governments, with all types of issues, there's a rate at which our economy has grown. Now, if we believe that that itself is not going to play out, then we don't have a case for investing in equity, correct? Then you and me should figure what to do, right? The second important thing is that when you talk about retail investors keeping on putting money, look, if they, if there is a 12 to 18 month or 24 month period, when the market stops rewarding them, then they will also reassess their options. They will also reassess their options, right? if the market does very badly, there is a good chance it will be accompanied by, maybe rates rising, maybe some disruption in the economy. People might look for alternative investments. So these are things, this also we have seen in the past.
Correct.
Right? Like in the early 90s, market was booming. When I started my career in late 90s, people would put only play money in the market. The government was borrowing at 11%. Why would anybody put money in the market? Then again, there was, a good period. Interest rates went down, market started booming. Then again, the 10-year bond went to 9%. Then again, people said, okay, if the government is borrowing at 9%, why will I put money in the stock market? So there are cycles, and there are times when, retail investors will feel that they are not rewarded, and then they'll want to look for other options. But in the background, all of us will need to keep in mind how the economy is doing. If there is a basic tailwind, which we have been blessed to see in the last 2-3 decades, if there is that tailwind which is not broken, then our faith will be rewarded.
Okay, so now let's look at, which I would also say is one of the favorite slides in my thing, because as a RA and hopefully soon to be a fund manager in the future, I look at what styles are working in the market, because everyone has a particular style in the market, right? And you have outlined, I think, 4 or 5 styles here, which is alpha, momentum, quality, value, low volatility, and the Nifty 500 index. Right? And you've also shown over periods of 2005 to 2025, almost 20 years, how different styles have become number one and actually gone down and then come up. So is this predictable, or how do we actually look at this or make sense of this?
So there's one of the pitfalls of human thinking. What is that? You must have heard that phrase, right? That if the only tool you have in your hand is a hammer, then everything will look to you like a nail. Right? So I've noticed this in the last 4-5 years. There has been a very violent rotation in macroeconomics. Right? I mean, if you take, when macroeconomic parameters change, which sectors, which styles will work, what type of stocks, when macroeconomic parameters will change, all of this will also change. So the idea is that, you should not just have a hammer with you. You should also have a jacksaw, and you should also have a drill, and you should also have
like a jack of all trades.
You should be a jack of all trades, basically, because it's not always that a hammer will work. So same way, what I've noticed in the last few years, Shashank, is that, people realize that 2017-18 growth style worked. 2018-19-20 quality worked. After 2021, value has worked. In between, at some point in time, momentum has worked. So because of violent change in macros, people noticed, and they may not have correlated it with macros. Actually, what I've seen is that people have obviously noticed that there is a point in time a different style starts working. And, anybody who's a practitioner of that style becomes the rock star when you talk about our industry or when you generally follow social media or whatever. So then people started thinking, even mutual fund companies, what they've done, they've also obviously pointed out that, okay, it's these styles which are driving at different points in time, different styles are driving performance. So what is the pitfall or what is the fallacy is that when we start understanding something, we start thinking we can predict it in future. So just because you got an understanding of the past doesn't mean you will be able to predict the future. And if you are talking about understanding from the past, if you ask me, the only takeaway I'll take from this slide is that different points in time, different styles are driving performance, but we don't know which one will come up next. Basically, it is unpredictable.
Does contra also unpredictable here? Like, agar
so contra is like part of value.
It's very bad in the last 2 years.
Yeah, that might work.
Then it eventually it has to become good wala logic. Yeah.
So I'll tell you. So from this, what I will take away from this is that you should have a portfolio which is a mix of styles or a portfolio which is blended.
Smart.
Because different points in time, different things are driving. A lot of people will see this and like you thought of being contrarian. So when people see this, they'll all try to figure out agle saal kaun sa chalega. To your listener who's a investor, for the investor, I think the idea is that, keep your portfolio blended because this is not predictable. The other important thing is, how would you predict this? See, it is related to macroeconomic scenario and the war doesn't, nobody announced the war.
Yeah.
Right? I don't think it was anywhere on our radar. See, value started working. After US started raising rates, okay, that people were anticipating. But China hit the tech sector very badly in end of 21 and Russia attacked Ukraine. I don't think China hurting the tech sector badly, and I don't think Russia attacking Ukraine was on our radar.
Never.
When Russia attacked Ukraine, then people thought there'll be shortage of energy because of oil and coal and all these things. And then commodity cyclical. And because commodity and cyclical in India has a preponderance of PSU. So first PSU rally started with, NTPC, Coal India, all those kinds of things. Now, in hindsight, you know that those 2 years value did well. But you couldn't have predicted the war.
Yeah. And even future, I don't know what.
In 2020, it's quality.
In 2020 is quality.
When 2020 started, before that, India did a big tax cut. When 2020 started, people thought, we are going to have, such a huge corporate tax cut. We'll have private sector capex revival. It should have been a high beta value, which should have done well. But COVID hit us and only quality did well. So in hindsight, it all looks beautiful, but it's actually, right? You cannot. First is you can't predict the macro. Second, I'll tell you even worse. You can't predict how market will respond to the macro. I'll tell you an example. In 2020 February, if somebody came and told you, Shashank, be careful, there's going to be a global pandemic. Okay, your portfolio will be down 40%. You all will be sitting at home, and so many things. So what would you do? You would sell your portfolio, sit in cash.
Correct.
You would be happy for precisely 6 months. After 6 months, you would say, who made that prediction? Yes, all of that you said happened, but the market is making new highs, man.
Yeah, that was shocking that it actually went up so fast.
In 2021, Shashank, if somebody told you that, US will raise rates, it will become some 6%, FIs will sell 50-60 billion, oil will go to $129, and Russia will attack Ukraine. In 2021, you would have sold your portfolio.
Everything I would have sold.
Right? Couple of years down the line, it didn't matter. It just came back. So why these styles are not predictable? Because they rest on macro rotation. And macros are not predictable.
And macros are so complicated.
Complex. And even if you predict the macro, how will market respond to the macro? That also
That is another problem in all.
Yeah, there's 2-3 levels of complication.
Wow.
So the idea is to takeaway is to keep your portfolio blended. All this, it looks nice, it's not predictable.
So it's easy to map the macros which you have done on top, but not easy to map the responses of the market to those macros. You can always map the macros, but you cannot respond. Okay, interesting.
What you said was very interesting actually, which is about trying to be contrarian. The only risk with that is that you might end up being too early and you might yourself lose your patience and throw in the towel.
But as a retail investor, if I'm here for we all say long game until 20% low. But if I'm here for 5 years, then if I'm playing contrarian, it should be a better.
Yes. The only, what I do believe, I'm not the biggest expert, but I do believe that if you can't do anything, then at least don't go for the hot one. At least go for the contra.
Makes sense. And this is something very interesting because this is my index that we will all track, right? BSE 500 is what most of us track. So can you explain this side? Because this is a change in factors of understanding my own index.
So this is also, another effort. See, Shashank, you must be meeting so many managers, or even your listeners, they must be listening to so many fund managers and so many popular guys. See, generally, people have these preferences or these biases. See, even before we spoke that people are putting so much money into small and mid cap. Now look at BSE, that was total market capitalization.
Correct.
Forget total market capitalization. This is just BSE 500. And by the way, BSE 500 is also some 94 to 96% of our total market.
Yeah,
I think it's fairly representative.
4,500 or 5,000 crore market cap and above. Yeah. Pretty much.
So now just see. I was telling at that time that, how much is large cap, how much is small cap. That was full market cap. But if you see BSE 500, 70% of BSE 500 is large cap. Now, if you are somebody who thinks that, okay, if I put money in active mutual funds, I should beat the benchmark. But you put all your money into small cap funds, then either you will beat the benchmark by a mile or the benchmark will beat you by a mile. Right? So the key is that when we construct our portfolio, let's say we are constructing portfolio for flexi cap or multi cap or special opportunity, whatever, where the benchmark is BSE 500. So we will be very mindful that we are competing with this. So our portfolio needs to be informed. I mean, isn't it known that you should study your competition. You should study your opponents. You should know their weak and strong points. So our competition is with the benchmark. Now, when I make a portfolio, if I come to you and say that, you say, okay, Aashish, how do you construct portfolio? I say, I believe in value. I think I should only buy stocks which are below 20 PE and below 2 times price to book. And, people are crazy. They are paying so much money for good companies. Bro, that's your opinion. Look at the index. The index is half growth and half value.
So index also is playing at 50% growth, 50%
The
value.
index is half made up of cheap companies and half made up of expensive companies.
So why are
Now,
you
can
thinking
say-
of 100% value?
Now I'll give you an interesting example. Every time you switch on TV or you watch, you listen to people on social media, it is an example related to this will come out very clearly if I talk India versus China. Haven't you heard a zillion times that India is expensive, China is cheap?
Yeah.
So you must have heard India PE multiple is 22 times, China is 7 times. China is cheap, India is expensive. That's a static picture. 7 times, 22 times. But if I tell you, since last 20 years, the guy with 22 times is beating the guy with 7 times.
How does it matter? Yeah.
So there must be something more than the 7 and the 22, right? So in the index also, a lot of people say you should buy cheap companies. That is true. But what if I tell you that more than half the time the expensive guys are beating the hell out of the cheap guys? So I am not going to get into those debates. It's not matter of religion for me. Your investing philosophy is not like matter of religion. The point is, if you want to beat the benchmark, you better be mindful that the benchmark is half growth, half value. Half cheap companies, half expensive companies, so-called. So if you want to beat the index, you don't take sides. You focus on what kind of portfolio is to be constructed
To break this.
to beat the index. So what we do, for example, what I would say, the takeaway from this is not to bet on one side or the other.
Yeah.
The takeaway here also is that when you make a portfolio, when macros will change, sometime large will work, sometime small and mid will work, sometime value will work, sometime growth will work, sometime defensive will work, sometime cyclical, sometime PSU, sometime private. When macros will change, what works will change. Just like you cannot forecast the styles, you cannot forecast which segment of benchmark also.
So you have to be fluid.
So the idea is that, yes, you need a blended approach. You should neutralize for all this. If you can't predict something, doesn't mean you don't cater to it.
Yeah.
If you can't predict something, the least you can do is you make sure that you are indifferent to it or you are.
Correct.
If it works like this also, I'm taken care. If it goes this way also, I'm taken care. So, if you can't predict and neutralize something, then you at least balance for it.
Got it.
So, like the takeaway is that you should have a blended portfolio, not growth or value, defensive or cyclical. People who are statistically oriented, look at when you find a fund manager, check the beta of the portfolio. So there's an interesting example, mathematical example I can give you. If I say that I have generated 4% alpha, meaning 4% more than benchmark. Yes. So you will say, wow, great. But you should be asking me, what is the beta of your portfolio? Meaning that beta is obviously the correlation of the portfolio's performance versus the benchmark. Now, people who are leaning on value, people who are leaning on rate sensitives, and people who are leaning on state-owned enterprises, people who are leaning on cyclicals, their portfolio beta will be 1.1 or 1.2.
Correct.
Which means that if the market goes up 1%, their portfolio should go up by 1.2%. In the example which I gave you, market goes up 10%, I will go up 14% because of 4% alpha. Now, if I tell you that my beta was 1.2, then your question should be, boss, then you not generated 4%. The fact that your portfolio itself is so volatile, the beta is 1.2. So if the index went up 10, you were anywhere destined to go up to 12.
Correct.
So you have generated 2, not 4. 4 levels of awareness. The first is that when we say that you're getting returns. So first people look at returns. Returns. Slowly the awareness is coming that no, returns meaning returns should be more than the benchmark, no?
That has come now.
So neither awareness is coming that you should beat the benchmark. Now, but the regulator is driving what we are talking. If you see in April, the regulator made it mandatory to disclose something called information ratio, which is how much alpha you are generating divided by how much is the volatility of your alpha.
Almost like Sharp only.
Yes, right. But here the thing is that the denominator is the standard deviation of the alpha.
Standard deviation of the alpha.
Alpha, yeah. So how much is your alpha? So it's like this that I may generate 5% alpha. But when I did badly, I'm minus 15.
So drawdown
and when
plus
I did,
growth divided.
Yeah.
Okay.
So if I generated 5% alpha over the last 3 years, but my worst was minus 15 and best was plus 20. So it is quite random. Can't stay with you.
Damn, that'll make it very competitive then.
But if somebody has 5% alpha, the worst is minus 3 and the best is plus 9, then you say, okay,
good.
This is
his drawdowns managed and his growth.
Yeah,
is...
I mean this person is not exposing investors to extremes, because when you expose people to extremes, their emotions. So if you want performance with narrow range of outcomes, if you want performance which is more, in a range, doesn't go all over the place, then your portfolio should be blended and balanced. Your beta should be 1.
Yeah.
It should not be 0.8 or 1.2. Because 0.8 or 1.2 will, the 0.8 guy will do very well in falling markets. The 1.2 guy will do very well in rising markets. But you want to be invested with someone in all markets. No, you can't keep changing your funds. So if you want somebody with consistency, they should not be generating returns from the direction of the market or by taking punts on either side.
Yeah.
They should be neutralizing for all this and generating return from the actual stock picking.
So market neutral is what they call it in US.
So, if you see,
Crazy.
last year nobody wanted to buy IT. But within IT, if you had bought IT companies serving BFSI or IT companies which are small cap IT companies, that is genuine alpha. Right?
Stock picking alpha.
Stock picking alpha. Stock picking alpha is a measure of skill. Alpha which comes by betting on direction of the market, betting on style, betting on factors like value versus growth. That alpha is, like you called the toss and it landed right.
Market given alpha. Basically.
Market gave you the alpha, so market will take it back.
Yes.
So whatever alpha you generate from all this style and sector rotation and all, no, that is luck. Whatever alpha you generate genuinely by stock picking, that is skill.
Like for example, the whole pharma, let's say pharma index did not move at all. Like it's only flat. But you have taken 2-3 pharma picks in that has given you the outperformance. That is a true stock picking alpha.
In 2024, if I had alpha, the alpha generated by picking a defense stock is less valuable than the alpha generated by picking a pharma stock. Because, there was a wave for defense stocks. So what is the chance that you will get alpha?
Higher.
Very high chance, right? Almost every stock went up and you may have done a good job, you went up a bit more. But that's part of the wave. When the wave turns, it will take it away. Most of it will be taken back.
But people have not realized that yet. I mean, people like the waves.
So you should actually fund managers who generate alpha from wide sources and not just from some momentum driven source or what is hot in the market. See, this data is the most interesting. I'll tell you why. I'll tell you the reason why. See, most people, 2-3 things I want to clarify. Most people, what they think, FIs are selling in India, kitna bech raha hai, India mein problem hai. Aisa lagta hai logon ko. But there's a fallacy in this. It's so interesting. In India, 50% of the market almost is promoters and government. Correct. Government as a promoter and genuinely the promoters. There's a huge part which is DI and FI. Now look at it this way. If DIs are continuously buying, somebody has to sell, no? There is a buy and a sell.
Correct.
So if DIs like the NPS, the EPFO, insurance companies, mutual funds, retail investors, bro, all of us are buying. So there are only 2 people left to sell, no? Either the promoter or the FI. Bechega kaun? So part of the reason why FIs are selling is because we are continuously buying. There has to be a counterparty.
But why? I mean, we look at it as a very wrong thing. FIs bech raha hai और promoter भी बेच रहा है.
But यार,
बेचेगा
अपने कंट्री में प्रमोटर का होल्डिंग ही इतना ज्यादा है. Yeah, but see another thing. Sometimes people say that promoters are selling and they are coming with IPOs and QIPs. So, but promoters, we are a country where promoters own 50%. On one hand, we are saying that if there is not enough free float, stocks will go up because of illiquidity. There is risk of some operator-driven illiquidity and rigging and all, right? So that will happen if there is such a huge promoter holding. So if promoter holding, if DIs are buying and promoter holding will come down and the market will be more widely distributed. If I'm not wrong, you may want to check this, but in US, large companies also, like say founder of Facebook, he might have single-digit stake in the company, right? And still, it's professionally managed. In India, promoters own a very large part. So if DIs are buying, who will sell? There has to be either promoter or FI.
So it's not a bad
There's nothing
thing.
wrong with it.
Yeah, we look at it as a wrong thing though.
No, we have to, so that is unfair and unfortunate. We actually want the promoter holding to come down. We want companies to be professionally managed and we want more free float.
Correct.
We are one of the rare countries where the regulator has to say that when you come with an IPO in a certain time, you have to bring it down to 25%. Why? Because promoters don't
Want to give.
Yeah, they don't want to give. We are reading it wrongly, actually. There'll always be good promoters and not so good promoters, but there's no quarrel with promoters selling or FIs selling.
Yeah.
And we want more issues to come in the market.
Yeah.
We want more part of the GDP to get listed. There's nothing wrong with it. Contrary to normal perception, FIs are not selling too much or selling consistently.
Okay.
This data is primary market plus secondary market. Lot of times people see secondary market data and they feel that there is only selling. But the selling will always happen in secondary market.
So
The
investing
buying
is
can
happening-
happen in secondary. Selling will happen only in secondary. But good part of buying will also happen in primary, no?
So for people who don't understand, primary is before IPO, like
At
private.
At IPO. When Hyundai IPO came, a good part of it was subscribed by, say, foreigners. But that is money coming in the market, no? It's primary subscription.
Yes.
So what happens when you look at FI data only in secondary market? You are getting, in terms of buying, you are getting half the data. In terms of selling, you are getting all the data. But before that, see 2010 to 2024, only 4 times it's negative. And when it's negative, it all this 500 million and 700 million and all is not some big negative.
Yeah.
It's like,
I mean, they have to take out some money, right? Itna dala to hai.
it's their investors' money. But see, Shashank, see the other emerging markets.
Heavier.
Tiny markets like Vietnam and Thailand are more negative than us. You know,
Yes.
FIs have treated India very, very well.
Yeah.
They are
Only
consistently
Brazil
buying.
is similar to ours.
Yeah.
Only Brazil.
Yeah, and Brazil would have benefited in recent times because of commodity.
Correct.
But India is actually a darling for foreign investors. It's not as bad as made out to be. And it's also true that India is, in last 20 years, best performing stock market in
Emerging
US dollar
market.
terms. No, in last 20 years, India has outperformed US in US dollar terms.
Okay. So Aashish, I think, first of all, mind-blowing, right? I think for all the people who have been watching to understand basically market cycles, portfolio, and I think the biggest takeaway from today was understanding my competition, which is BSE 500. Not looking at, ascending to descending, descending to ascending, top performing.
See, I always tell people that, a portfolio, like a lot of people say my portfolio. Now, the thing is that every list of stocks is not a portfolio. When a mutual fund guy says it's a portfolio, there is some benchmark, there's some investment universe, there are some do's and don'ts, right? And every day there is an NAV, the performance is declared versus the benchmark. Most guys, when they see their own portfolio, it probably is just a list of good ideas and probably impacted, unfortunately, by recency bias.
Mostly
Recency bias. And it's not benchmarked to anything. You don't measure your performance versus the benchmark. A lot of times people don't tell you their portfolio return. They deal more in anecdotes. So these are challenges.
And the key term that I learned today is don't do what others do.
Yeah, I mean, you should not be part of the others. That's the key part.
Wow. Perfect, Aashish. I think superb. I'm very happy because this was also a very nice moment for me to have gone through this report with you. So that's one of the highlights in my investment journey as well. And again, thanks a lot for giving all this knowledge and all this data.
Thank you. Thanks for inviting me.
Thank you. So I hope you guys enjoyed today's video. Obviously, it was power packed with a lot of information, and all of this would not have been possible without the help of Grow. They have been instrumental in helping our channel grow as much as possible, and also me increasing my research team and content team for this. So we are part of the Grow network, and if you want to have any more information about stock investing or you want to understand which platform to use, you can definitely check out the Grow app, which is in the description below.